great news for Newfoundlanders and Labradorians. It's great news for Canadians. This is the right move, in my opinion, right now, and I applaud the Bank of Canada for their decision.
Over the past week, 3 premiers have written to the governor of the Bank of Canada calling for a pause on interest rate hikes. Today, the Bank of Canada did just that. That leaves the benchmark rate at 5%, the highest it's been since 2001. It's been raised 10 times since March 2022 in an effort to bring down inflation, but it's made mortgage payments skyrocket for many Canadians. Looking forward, the central bank says it is prepared to increase the policy interest rate further if needed. Former Bank of Canada Governor David Dodge joins me now. Governor Dodge, thanks for coming in.
Good to be here.
Let's start with the decision itself. Do you think Tiff Macklem and his team got it right?
Yes.
You think this
Simply,
Yep.
yes. Whether the peak of this cycle was at 4 3/4, 5, 5 1/4, in the end, those quarter points won't make very much difference.
In the macro sense. I mean, the individuals,
Right.
obviously, it matters.
In
right?
the sense of bringing prices under control.
Now, one of the things they said as to why they held is they look at some of the economic data. It's gotten a little bit worse than they projected earlier in the year. There's been some suggestion the bank might be at risk of overshooting on interest rates. Do you think there's a possibility they overshot in bringing the rate up to 5, and even though they're leaving it there now?
Well, that was the debate 2 times ago as to whether to go up to 5, right? It's a very fine decision when you're in that range. So, yeah, is there a possibility that 5 is too much? Yes, a little. Just as there was a possibility that 4 3/4 was not quite enough. But it's a fine judgment call.
So what do you make of the economic data that we saw there in the decision? And we've had people like Jimmy Jean from Desjardins on last night suggesting we might be in a recession here. Where do you think we are as an economy in Canada right now?
Well, my view has been that we needed to go through a period of maybe about 4 quarters of essentially zero growth, at least something close to zero, with potential something at 2, 2.5, would open enough gap between potential and where we are to put enough downward pressure on prices to bring that inflation rate back down towards 2%.
So in the run-up to this decision, there was a lot of public pressure being put on Governor Macklem and his team, right? The premiers of British Columbia, Ontario, Newfoundland and Labrador all wrote letters saying, do not raise interest rates. We've seen the leader of the federal NDP, Jagmeet Singh, saying it's time to review the Bank of Mandate, and his office even suggesting Chrystia Freeland should ask Tiff Macklem directly not to raise interest rates. What do you make of all of this political pressure? Is this appropriate?
Well, we've been through this once before with Jimmy Coyne many years ago. And the issue is that the government can always instruct the bank, and if the bank doesn't want to do it, the governor will resign. That is always there. So Tiff Macklem's and the bank is acting in their best judgment as to what is necessary to fulfill the mandate that the government has given them.
Right. So premiers doing this, I mean, they have no direct authority over the bank. They can't direct the bank, but people might consider it improper for politicians to do it. What the NDP is suggesting, that maybe the finance minister and the finance department should ask the bank governor directly. Did that ever happen when you were there, and would it be acceptable if they did in any kind of oblique way?
I talked with the minister and the prime minister, just as Tiff is doing now. And Tiff's fully aware of the difficulty that higher interest rates are causing for consumers, for businesses, and for governments that have big debts.
Yes, but I mean, would it be appropriate for the Minister of Finance to lean on him in any way, to say, please don't raise interest rates? Is that an appropriate function between the two offices, do you think?
Look, the Minister and the PM can well express the view that they really think it would be a lot better if he got it down, right? Now, unless they want to change his mandate and rip up the agreement that the government and the bank have, then it's up to Tiff to make the bank to make the decision as to what best achieves the mandate that they have been given.
Right. So we're at 5% now, 10 rate hikes, which is a lot. And certainly, for people who are renewing their mortgages, and a bunch of Canadians are going to be redoing their mortgages.
Well, it was
over the next
5% when I began my term.
Right. Well, but we've had this period of such historically low rates.
Exactly.
Right? So it's causing all of this pain. Where do you think we are now? I mean, this is a pause, but every bank statement now is like, we are resolute on getting to 2% inflation. We will consider further increases if we need it. Do you think we are near the ceiling as to what Tiff McLemen's team might have to do?
Well, as I think, but who knows? I think that we're in a period where growth is going to be sufficiently below potential that it really is dragging down the rate of inflation. It'll take time, and the impact increases over time simply, in a simple way, because people are renewing their mortgages. And there are more people that are running up against the fact that they've now got to devote more of their income to paying for their mortgage.
So we've got this situation, though, where mortgage costs and shelter costs are such an increasing part of the headline inflation number now. And there's been criticism leveled at the bank that the interest rates, because of the knock-on effect on housing costs, is actually driving inflation. I mean, do you buy that argument? And how would you balance that as a central banker?
The answer is that it drives the statistical measure. There's no question that it drives the statistical measure of inflation. I mean, that's the mechanical. But somehow you've got to take some demand out of the system, and the demand that is coming out is coming through those higher interest payments, which are bigger than the higher income payments that all the old folks that have GICs are getting, right? Remember, that not everybody feels pain from rising interest rates.
Right.
But on balance, enough people do so that the amount of demand comes down. And as demand comes down, it comes in, then we get balance with supply, and we manage to get prices back into line.
So what are you watching for next? I mean, we're going to see a lot of people renewing their mortgages, so that's going to hit even broader swaths of the population and the economy. We'll be looking for CPP, job numbers, GDP numbers, all of these things. What are you looking for that will give us a clue on where this is all going?
So, I mean, I don't know, and I don't think anybody knows. And there's a lot going on, and look, I really want to make this point that's important. Don't ignore what's going on in the rest of the world, and what's going on in the rest of the world is, in fact, having an impact on prices. For a while, that impact was to put prices up, the prices of our imports up. Now, as the rest of the world is softening, it's bringing that down. So there is a force, another force, other than what we are doing domestically. But what do I think is the best guess as to what's going to happen? We're going to have zero growth for essentially 4 quarters. That will indeed bring domestically generated prices down, and that, along with internationally generated prices coming down a little bit as the global economy softens, is going to begin to bring us, by the time we get the second half of next year, is going to begin to bring us much closer to being in line, and that at that point, interest rates can come down somewhat.
Okay. David Dutch, always good to talk to you. Thanks for coming.
My pleasure.